All right. Well, thank you, folks, for showing up. I'm Victor Wagner, and I was just scanning the room, just kind of see if anybody was like sweating and nervous. And if you have a tax confession, I can't arrest you, but I do have summons authority, so we could delay the meeting a few minutes. We could go and I could hear your confession, and you can come back and continue. The concept of a perfect tax return is very simple. Well, let me ask you this. Just to talk about audit rates, there's really the two highest groups that get audited are the high income people. Threshold is roughly about $400,000 of earned income. And it's not just strict W-2 or whatever, it's kind of a calculation of cash flow and whatever. It's just not adding up line 1 or 3 or 5 or something, or taking total income. But it's a 400,000 plus group that has a higher audit rate. And then also, maybe, sounds a little counterintuitive when you first say it, but when you look at the elements of it, it's the lowest income group. And both of those rates are about 5%. 5 is maybe as much as 10% on the larger income individuals. And then everybody in between, it's very low, less than 1%. What I wanted to make is that the higher income levels and do things that the lower income levels who get audited high also don't do. A lot of the problem on the low end is fraud. How many kids, you want $5,000 refund, how many kids do you need? You need 7. Okay, here's 7 fake Social Security numbers. You need 2 W-2s to get your maximum earned income credit. It's a big problem, folks. It's big. We got folks in our office that, and it's not so much the taxpayers as they tend to be, unfortunately, unsophisticated folks. But there is a community of preparers out there that, will in exchange for larger fees, file fraudulent returns, and people get fat checks back. So when you hear the audit rates high on the low end, that's really what's causing it. Fraud in the earned income credit and the child care credits. Then there's been additional fraud with employee retention credits, COVID loans, things like that are unique to the last couple of years. So those are the two high audit areas. What I wanted to talk about with the perfect tax return is how you can insulate yourself from an audit period. And the idea is simple. What is there? Okay. I have the question with the answer. If all the income and expense information compiled into your personal return comes from someplace else, what can the IRS look at? So think about it. If you're employed, you have a W-2. That's something that's, I'm not going to audit you for a W-2. I mean, that came from somebody else. This W-2 can be incorrect, but on your return, there's really nothing to look at. The same thing for any information document you may get. A W-2, 1099, or a 1098, or you get a Schedule K-1 from any of the listed entities there, a partnership, 1065, a subchapter S Corp, and a trust. They issue you what's called K-1s. So the whole concept, very, very simply, is to create a perfect tax return that the IRS computers will just ignore, which is everything comes from someplace else. The biggest risk area you have, and I'm not saying anything that you can't find out in public, anything I say tonight is out there. You might not be able to find it, but it's out there, is that as long as all your income and expense is coming from someplace else, there's nothing to look at. So, from a tax return standpoint, if I was doing your return, I would sit down with you and say, how do we structure you so everything that you do comes from someplace else? Because at that point, your risk is 0. And I like 0. I'm going to kind of reinforce this point. Schedule Cs, I think we've all, if we've prepared our own returns at one point, kind of maybe have done a Schedule C. That's a sole proprietor, self-employment form. That's got the highest audit rate. I forget what, 5, 6, 7%. I forget what the numbers are, depending upon what you are. But if that's what will draw the highest attention typically on your return. About one thing, there's 2 parts to an audit. There's where you make a claim of income or a claim of expense that the computer kind of judges doesn't make sense. And we'll go into some issues where that can be brought up. And then the other part is, well, if that information doesn't come to you, or you're not the one writing it down originally, then there's nothing to audit.
Can I ask a question?
Right here. Single member LLC defaults to a Form 1040 Schedule C for active trace. Not good. You don't want, if you're going to form an LLC, always make sure you have two. There's also a legal reason. If you, the state legislature, I don't want to get way off on it, but there's something called a charging order. Charging order is like a lien, or if you get a lien against your LLC, if you're a single owner of that LLC, it's easier for the lawyers to pierce through the LLC to get the assets, because you're almost considered the same. The LLC and the owner are, merged. I think they call it lien theory or something. But if there's multiple owners of the LLC, the law recognizes that you can't go in there and break the LLC apart. That destroys the business to the detriment of the other owners. The three most common, again, I'm talking about real estate, not about maybe any other business types. Because again, Subchapter S and other formations come into play, and I'm not going to try and get off and cover every single thing and every single avenue. But we all know what a limited liability corporation, right? You can form one, $150, Sunbiz, get your best friend or whatever, your worst neighbor to be your registered agent, you're off and running, right? Not hard to do. Most important thing I can say is make sure you're multi-level, at least two owners. I personally like myself or my wife and another entity. And I control the entity. That might be a 99-in-1 itself, but legally it's two separate people. And that's a very cheap form of insurance from a lawsuit. What you can elect the LLC to be by filing a Form 1065. So once you have two members, you can choose to be a corporation as a C or an S, or you can be a partnership. Preferably in real estate, partnership by far is the preferred entity. I can get into some specifics of tax capital and negative capital balances and loans, non-recourse and recourse loans, but I think that's beyond what we want to do here. The land trust. The land trust is this animal that's really gained a lot of popularity, and I think it's probably gotten too much popularity for, I don't want to say bad reasons, but I think it's gotten a little bit of hype from, gurus who are trying to sell a course. A land trust is basically what we would know, I would call a or a revocable grantor trust. Very simple. It's just another name. They call it a land trust because it holds real estate. One of the audit problems that I see out there is this whole concept, and it's going to tie neatly into the whole idea of how we structure our assets, is this concept of ordinary income versus capital gain income. A lot of investors think income's income. And the fact is, in one sense, all gross income is taxable, yes. But on a true tax level, no, it's not. Income is not income. When I mean ordinary income, I'm saying it comes right, I put it in black and white, it comes from the profit or loss of an active trade or business. And I think it's, there was a comment, but maybe Bob made it, about, how did you say it? Something about how cryptic the code is and all that and whatever. One thing I learned, especially joining the IRS, is, and I never thought about this as a CPA, is a lot of the code is written to tell you not what you can do, but what you can't do. And it's really kind of pro-business in that sense, in terms of it's not trying to tell you you can only do A, B, or C. It's trying to, most times, and again, the code is so different because it depends who wrote it, when they wrote it. The styles are different, so you might read one sentence and then it got amended and the style is completely different. So, it's not a smooth flowing, wonderful Harlequin romance novel or anything. It's far from it. It gives you a headache. But the point of it is it's mostly telling you what you can't do, leaving your creativity to create whatever you can do. For investors who are doing all types of the business, is they mush it together. They'll have one LLC and they're doing wholesaling. They've got an agent's license or a broker license. They've got investments, rentals that they're holding, and they've got land or something else, some options sitting out there, all types of elements of an investment portfolio. And the biggest issue I see is they kind of throw it all in one big soup, and that's a no-no. Please don't do that. Please understand there's passive investment and ordinary trade or business, and the taxation is higher on ordinary income. And you get preferential capital gain rates, which we probably all know. So the incentive, of course, is to call everything capital gain. Well, that's what we look for. Mixing the activities of an active trade or business. Why is that a problem? Well, because they're two different tax rates. Guess which one's lower? So the downside of it all, and the big complaint is, well, it's extra tax returns, it's extra work, it's extra. Yeah, it is. But that's your call. You want to mix the pot and take the chance that you're going to have to fight your way out of a ordinary trade or business argument for your legitimate capital gain holdings, or you're just going to set it up right and do it right from the beginning. And believe me, if an agent walks in, sees you have it segregated, your books look good, don't have to be perfect, don't have to be, absolute pristine, but you understand the difference, you're 99% of the way there, I'm telling you. We don't have time to fight you for nickels and dimes. What we're looking at is the big picture. If you screwed up the big picture, we're pretty sure you got the rest of it screwed up. If you got the big picture right, chances are you're going to be in good shape for the rest of it. Benefits available in the financing of real estate and how it matters to set it up properly so that you can maximize your benefits. So, for example, installment sale, IRS code 453. Okay, I'm going to make the presumption that we're all what we'd call cash basis taxpayer investors, which as individuals we are by default. The capital gain is recognized as you collect the cash. Okay, that is the essence of an installment sale. Because you are an investor and getting capital gain treatment, if you take, as we call paper, if you become the bank and finance the deal, you don't have to pay all the tax on the front end. You pay as you collect on that note. And you might say, well, that's common sense. Why would I pay up front when I don't collect the money? Well, the problem was until this was passed by Congress years back, if you sold the property, took capital gain, but you financed it, you still had to pay all the tax right away. So this provision of installments, and it's been out there for years, basically said you pay the taxes you collected, which is a common sense economic argument. Now where it matters is if you're if you're back in this active trade or business period, as a business owner, you get what we call dealer status, where basically your real estate's considered inventory, no different than a product on a shelf at Publix or a car at a dealer or whatever. It's inventory. Just the fact that it's bricks and sticks doesn't mean anything different. And so you don't get installment sale treatment, meaning that if you sell your property for $100,000, you make $50,000 on it, and you agree to finance $90,000 of it, you're paying tax on the whole $50,000 1 year. If you have capital gain treatment as a passive investor, you pay that tax as you collect the principal over 30 years, 10 years, 5 years, whatever you negotiate. Big distinction. Another reason you want to make sure you've got yourself in the right category. Because I'm at the age, I have friends, we don't want to sell for cash. Now interest rates have went up in the last year or so. We love paper. I mean, whatever you can learn from these guys, learn it, because it is gold. Paper is gold.